This is why it's so important to really have a diversified portfolio and make some adjustments based on what's going on in the markets, because right now the tech sector carries so much weight into the market. So good afternoon. The Fed meeting minutes are in, so we will cover a little bit of the behind the scenes from the most recent Fed meeting. My name is Brandon Steele, financial advisor with Mainsail Financial Group, and our goal is to leave you feeling more empowered after every interaction. And in these weekly updates is to break down some of the news, the data, the trends that we're watching, and hopefully weed out a bit of the noise along the way. And this week, there's kind of two main areas we're going to focus on, although there's some other data we'll cover as well. One is the Fed meeting minutes, and then a great question of the week around kind of what's going on in the markets here more recently with a bit of a pullback, but a pullback driven from a very specific area. So we'll drill into that here in a little bit more detail. Before we get to the question of the week, a couple things I want to cover on the data front, and then we'll cover the Fed meeting minutes. So going back to last Friday, we had retail sales numbers come out. So the retail sales were up 0.5% there on Friday, right in line with expectations. And keep in mind, coming off a pretty huge up month the month prior as well. So again, retail sales up 0.5% on the back of an already, pretty significant number there for the prior month as well. Today, we have initial jobless claims that came out, and we see 235,000, so a bit higher than expected. This will factor in a little bit for what I'm going to cover here on the Fed, but something to just keep an eye on. Obviously, the labor market is becoming a key focal point for the Fed's conversation moving forward, and so I just want to make sure to kind of keep an eye on what's going on with jobs and the labor market in general. But the big thing to cover here this week is the Fed meeting minutes. So just yesterday on Wednesday, the minutes were released. And overall, if I'm going to simplify this, it's really very much in line with, I think, what we heard from Fed Chair Powell in the press conference to follow. So if you were tuning into that weekly update, you probably have kind of an idea where I'm going with this. But the general theme was that it was a pretty divided Fed. Tariffs, inflation, and the labor market were really the three main areas that they're focused on at the moment. It's important to note that two members did vote against the Fed's decision to hold rates steady. So again, two members did actually suggest that we should be cutting rates basically, and voted for that directly. The big thing to be aware of is that they basically, the reason that they left rates the same from what we can kind of gather from the minutes is that they kind of believe that the risk of inflation outpaces the concerns of a weaker labor market. Now, again, that essentially was what came out of the press conference, a couple weeks back, but the minutes certainly would suggest the same story to be true. There is concerns around what could happen on the inflation side of things. And basically, they felt keeping rates higher for a little bit longer was better than cutting rates to try and boost the labor market because of the concerns of how that could translate to inflation. So hence, no cuts in the last meeting. Again, basically, the simple version of this is it was pretty much what was shared in the press conference. And now that will suggest that, as we look forward, it's really going to be critical to watch this from here. The Fed did mention a lot about the labor market in the last conversation. So we'll continue to watch both inflation and the labor market. To be clear, those are the Fed's dual mandates, inflation and labor market. So we will continue to watch both of those numbers. But again, from the minutes, it suggested that they were more concerned about the risk to inflation than the potential challenges to the labor market. The other thing I want to touch on briefly is that this all translates very well to what we will be touching on next week, because tomorrow the Fed Chair Powell has a speech or has some comments that he will be sharing at Jackson Hole. So the markets are really watching for his comments tomorrow, I think, in terms of what comes next. But we also will get consumer confidence and the first GDP revision there. So be sure to tune in next week. The market's eyes are on the Fed is the simple version of things. And the comments tomorrow certainly will be impactful for number one, where we might go from here. Number two, any sort of market reaction, which will all tie in very nicely to our question of the week, which again is really around what's going on in markets here this week, and how that translates to really some specific areas that are creating this slight downturn over the last couple of days. So basically, again, all eyes are on the Fed, I think is the simple way to put it. What we have seen here more recently is that the markets on Tuesday and Wednesday had a decent pullback, nothing, super alarming, but nonetheless, it was, a decent pullback. However, what's important to be aware of is, and this is why it's so important to really have a diversified portfolio and make some adjustments based on what's going on in the markets, because right now the tech sector carries so much weight into the markets. So if you turn on the TV and you see the markets are down, a lot of times what that means is that tech is down because of how much it impacts the rest of the markets. Doesn't always ring true, right? So please take that with a grain of salt, but that certainly was the case this week. So what we saw on Tuesday and Wednesday as markets pulled back a bit was primarily led by some of those big tech companies. In fact, a lot of other companies that make up the S&P 500 were not just not down, but in fact were up. So this really was a tech-led sell-off here over the Tuesday and Wednesday sessions. And there were pockets of opportunity that were actually doing very well during that period as well. In fact, I guess, there's also maybe more companies that were doing well than weren't, but because of the size of these tech companies and how it relates to the weighting on the indexes, it brought the whole index down. Yeah, so that's really important to be aware of. And this is something we've been watching very carefully because some of these valuations have gotten extremely high. And again, these tech companies make such a big impact on the indexes as a whole. So just keep that in mind. If you turn on the TV and you hear the market's down, just be aware it may not necessarily translate to your holdings depending on what you actually own, which is again where maybe some tactical allocation changes can be really helpful in this current environment. But I did want to highlight that it is important to be aware of, because if you actually break apart what was going on there, again, there's really the big names that were dragging things down for the last couple of days. So we'll continue to keep an eye on this. I think this is kind of a natural, evolution as valuations get high, but it's definitely something to watch here moving forward because of how impactful they are on the broader markets. I hope that helps. A little bit in the weeds for sure, but hopefully this gives a little bit more insight into what's actually going on behind the pullback there on Tuesday and Wednesday. Be sure to tune in next week. Again, we are going to be covering the Fed Powell comments from tomorrow from Jackson Hole, and then we'll address consumer confidence and the first GDP revision. In the meantime, have a great upcoming weekend, and we'll see you next Thursday at 3.